Hello there. Good day. I trust you all got your quiz taken yesterday and you are ready for your next lesson in personal finance. Here we go. Today we're going to be talking about ways to save. Okay? Really fairly easy, and I hope it's fairly logical for you. There are two aspects to savings. One is reducing expenses, and the second is setting aside money before there's an opportunity to spend it. So reducing the outgo and increasing the income, basically. Two aspects of savings. Reducing expenses means developing that budget and sticking to it. Okay? We've already talked about budgeting, we've talked about many of those different things. But the second aspect of saving is setting aside money before there's an opportunity to spend it. And this is more of what we're going to be talking about today. This is a disciplined, systematic saving schedule. And those of us who can be disciplined with our savings, much like being disciplined with spending time with the Lord every day, will find that in the end, we'll have more left over. We'll be able to save those amounts and be able to give more, because ultimately our lives are about giving and giving back to the Lord what He's given to us. Most financial advisors would recommend to you that you save 10% of your paycheck each month. That's just a starting point. 10% for the Lord, 10% for savings, and then increase those amounts as you are able to. Of course, the more you can save up front, and we'll get into this in a future chapter, it's, I believe, the next one, compounding interest works in your favor, and you end up with more money in the long run, the more you can save up front in the early years of your adulthood. Okay, so let's talk about some different ways to save. The next several slides are going to go through some of the ones in your book on pages 228 through 231. Okay? First is the automatic payroll deduction. Now, most employers anymore offer this, and what this does is when you get your first job, many of you may have already had your first job, if your employer does automatic deposit of your payroll check, then you can decide right then and there up front, I'm going to deposit $15, $20 from every paycheck directly into savings, or a percentage. The first 20% goes into my savings account. The rest of it goes into my checking. You can decide that right up front. And that helps you get into that habit of always saving some money. So it automatically deposits a percentage or a set amount from your paycheck into a savings account. The second method is very similar to this, only it's more out of your control as far as, but in the first one, in this system, in the automatic payroll deduction, both of those are your accounts, and you see every penny that you made go into your accounts. In this one, the employer savings plan, sometimes this is where an employer will match a certain percentage of money that you decide you're willing to save into either company stock or into an IRA or into a different stock program of some sort. So this one, you may not see every penny of it every month. The most popular one of this is really an IRA program. And a lot of times an employer will match up to a certain percentage of your income. For example, most employers are matching 2 to 3% of your income. So if you agree to save 3% of your income for every $1,000 you earn, and that you agree to save, let's say you saved $1,000, your employer will match that $1,000 up to 3% of your total income. Okay, so let's go back and do some math again. Let's say you make $10,000 a year. Then 1% of that would be, what, $100? I think that's right, $100. So if you say, okay, I'm making $10,000 a year, and my employer will match 3%, that would be $300. Right? So you're going to save $300, but your employer is going to put another $300 on top of that. And really, for $300 that you would have had, now you have $600. So it really comes out to a really good program for you if you do it. The way we do it for ourselves is we go in as far as we can get matched. We don't go beyond, because we're really making money on what my husband's employer will match. Okay, so it usually does require, though, that you leave the money in the account for a set amount of time, and you aren't just taking it right back out. That kind of defeats the purpose for the employer, so he wants you to keep it in there for a predetermined amount of time. For us, we're depositing it into an IRA, so we're saving it for our retirement. So that we aren't going to take it out anytime soon. That would be crazy, because taking money out of an IRA is expensive. You've got to pay it back with penalties. Okay, another way to save money is to claim fewer exemptions on your taxes. Federal and state governments calculate your tax based on how many people are dependent on your income. The more people you have dependent on you, the less tax you pay and the more you take home. That means that if you claimed less exemptions, let's say you have 5 kids, 7 people dependent on your income, you claim 3. That means the IRS is taking too much money out of your paycheck every month. And then when you go to file your taxes, you get a nice refund. Well, that's all well and good until the IRS changes all the rules on you. So it's really not a good way. It's basically, I like to look at it as I'm loaning the IRS my money for the year. I don't want to do that. I want to get as close as I can on taxes instead of letting the IRS borrow my money for the year. It is unpredictable and it's easily wasted. When you get that nice little refund check in the mail, it's easy to go out and waste it on something instead of putting it aside for savings. Some of you may think of this in reverse as well, that if I claim, let me get it right here. If I claim more deductions than I have, if I have only 3 people dependent on my income, but I claim 6, then they take less money out and I have more to stay at home with. It doesn't work that way. If you get to the point that you have to file your taxes and you have paid too little tax and you do it on a consistent basis, you can actually find yourself having extra fines put on your tax, and severe penalties, really bad. I mean, you can go to jail for doing something like that. So you definitely don't want to do that. My advice would be to stay away from this idea altogether. Learn how to be disciplined in your savings and don't rely on the IRS to do your savings for you. The next one is doing an automatic transfer from your checking to your savings account. Most of us keep our banking on an app. I do. And I can set up in my app to automatically deposit money into my savings account on the 16th of every month. I get paid on the 15th, so on the 16th, you're going to transfer $100 to my savings account. I know the money's going to be there. It's just a matter of depending on it and making sure that I remember it's going to come out so that I don't spend that money. So that is one way you can do that. You can do it every month, have it done every month, every week, however works best for you and your family. You can also save from unexpected windfalls. Maybe you get an inheritance or a work bonus. Hopefully not too many inheritances, because that would mean you'd have people around you that were dying. Maybe a cash gift from a family member or a rebate from a purchase you've made. Anytime you get money like that, make a habit of spending 25% of it and saving 75%. Set up your percentages differently. Spend half, save half. Either way, if you make it a habit when you're young, it's easier to continue it as you get older. I thought this was an interesting idea that your book gave, is adopting a frugal month. Have a burst of savings every year where for 1 month you make it a contest in your family to see who can spend the least amount of money. No clothing expenses. Don't buy any new pieces of clothing that month. No furniture, no no extra groceries, reducing amounts that you spend on your standard utilities, whatever it takes, reducing every expense as much as possible for the month. Another one is to continue an installment payment when a debt is paid. Let's say you get your car loan paid off. Well, don't stop paying that money. Continue paying yourself that money from your car payment and set it aside for a vacation or for whatever else you want out of your savings account. Save your raise. You get a raise at work, save the difference. You're used to living on one set amount, so take the difference and set it aside every month. Bank the difference. Don't just automatically adjust to the new income. Or stash your cash, keeping a jar for loose change. I do it. I have two downstairs right now. One is for quarters that I'm saving for my son for in case he needs it for laundry this summer at the Wilds. The other one is for everything else. But I have a jar of cash that we use for change. That way I don't carry it around with me. Of course, this can be dangerous if others know that you keep cash around. It can make you a target for thieves or something like that. I know my in-laws, one time when they moved, they had a large jar, I'm talking like, 5-gallon jar that they kept coins in, and it got stolen off their moving truck. So it's easy. The thing about cash is that it's easy. It's not easy to trace. Once you give that dollar to somebody, nobody else knows you ever had it. So it's easy to steal. All right. The only other thing we need to talk about is electronic money. And this you all probably are familiar with, but your book goes into it at this point, so I want to make sure I cover this. The electronic funds transfer system that our banks use today means that large amounts of money go from bank to bank, from bank to merchant, and vice versa, all over the place without actual money changing hands. So the electronic funds transfer system includes many different things, meaning banks can deposit your check, your payroll check, they can pay your bills for you without actual money ever changing hands. So I can, from the convenience of my phone, I can deposit checks, I can pay my bills, I can, receive my payroll deposits, all those kind of things. Wire transfers are a little different. Wire transfers go from bank to bank. For example, one of the things my husband does every day is if their company is going to make a purchase of land, they will wire funds from one bank to another bank so that they cover that purchase. So wire transfers can go from bank to bank. The other kind of electronic funds that we are familiar with is the point of sale system. This enables us to use our debit cards at merchants. You're not actually exchanging money, but you put that debit card in and you pay your bill and you walk out. Now the merchant has his money pretty much immediately, whereas it comes out of your account right away as well. Okay, those are the only things I have to do today. Your quiz assignment today will be a little different, so look out for it. I'm looking forward to seeing what ideas you can come up with to add to our interesting ways to save money. All right, have a good day.